So to continue, remember, we are working on an example of a call bought with a strike price of 2,700, expiring on the first Wednesday of June, okay? And you pay for that $90, okay? That's the premium. That's the premium paid to have the right to buy. Instead of buying a future, you buy the right to buy a future. And we have clearly explained when you exercise it and when you abandon it. And in order to understand it, I want to focus with the call on the speculator, not on the hedger. We are going to start trying to master the call throughout the example of a speculator, okay? So why would you buy a call instead of buying a future? Why is that? You tell me. Think. You must think quickly. Okay. You bought a call and you paid $90 as a premium to avoid the risk of a bad decision. And which could be a bad decision? If you want to go long, you have two alternatives. Maybe you have three, but I'm going to speak of just two, which are buying futures or buying a call. You can also sell a put, which is another alternative to go long, but let's forget that for the moment. Okay, so again, you want to go long, you buy futures or you buy a call. If you buy futures, you don't pay anything. You just pay the commission to the broker, okay? And you outright go long at 2,700. The prices goes up $100, it goes to 2,800, you make $100 profit, okay? If instead you bought the call and you paid $90 of a premium and the price goes up to 2,800, you make as of a difference between the future price at the moment of exercising it, $100, yeah, because you have the right to buy it at 2,700, the price is at 2,800, you're making $100, but you need to discount the premium paid. So net, you made $10. Only that. You make some money, but you would have made more money buying futures, okay? What does it mean? That it's always better to buy futures? Not at all. It's better to buy futures if the market definitively goes up, okay? Because you don't pay any premium. What about the market going down? When the market goes down, you then exercise the call and you limit your loss to the premium paid, which is the $90 in this example. Just your loss is going to be just $90. Let's suppose the other way around. The market goes and finishes in 2,600. The one who went long at 2,700, he's going to lose $100 when you're going to lose just $90, which is less. But what about the market goes to 2,500? You're going to be the king compared to the one who bought futures, you understand? So in any case, the premium paid is giving you a strong protection against a big decline. And furthermore, when you deal with options, as we said in past encounters, you don't need to pay initial or variation margin, while when you deal with the futures, you need to pay initial and variations, okay? You just pay the premium and that's it. Okay, it's clear? Okay, see you next time then.